So hi everyone, I'm Sweet and I'll be presenting about cost behavior and cost volume profit relationships. And my partner for today's report is Eileen and she'll discuss about variable and absorption costing. So here is my outline of my discussion. Cost behavior analysis, separation of mixed cost, the high-low method, the least squares regression method, scatter diagram, and cost volume profit. In CVP, we'll also discuss the break-even point, assumptions in CVP analysis, contribution margin, graphing CVP relationship, CVP analysis with target income, margin of safety, and sales mix and weighted average contribution margin. Profitability is just around the corner. This is a common expression in the business world. You may have heard or said this yourself, but the reality is that many businesses don't make it. Business is tough, profits are elusive, and competition has a habit of moving into areas where profits are available. And sometimes, business owners become frustrated because revenue growth only seems to bring on waves of additional expenses. So, even to the point of going backwards. So, that is why it's very important to study cost behavior. So, what is cost behavior? Cost behavior refers to how a cost reacts to changes in the level of activity. As the activity level rises and falls, a particular cost may rise and fall as well, or it may remain constant. So, for planning purposes, a manager must be able to anticipate which of these will happen, and if a cost can be expected to change, the manager must be able to estimate how much it will change. To make such distinction, costs are often categorized as fixed, variable, or mixed. So let's start with fixed costs. Fixed costs are those which do not change with the level of activity within the relevant range. So these costs will be incurred even if no units are produced. For example, rent expense, straight line depreciation expense, etc. So fixed cost per unit decreases with increase in production. So let's have an example. Let's say our company is Arla and our product is fresh milk. So let's say we create this product and sell them at our store, and the rent and salary expense total to 40,000. So let's have a graph on the x-axis, our the cost driver activity. On the y-axis is the cost. So the rent and salary of 40,000. And our question is, how is this going to change based on our cost driver activity? So let's say if we produce 5 units of fresh milk, the fixed cost is still 40,000. So let's plot it in the graph so we can see the movement of it. So if we produce 10 units of fresh milk, the rent and salary, which are the fixed costs, are still 40,000. Or total to 40,000. And so if we have 15 units of fresh milk, the fixed costs are still 40,000. So the fixed cost based on total stays the same. Now, let's know how do the fixed cost per unit change based on our cost driver activity. So the fixed cost per unit is the total fixed cost of a company divided by the total number of units produced. So in this case, if the company produces 1 unit or 1 fresh milk, it means the fixed cost is still 40,000 because it's not gonna split over, right? Because it's only one. So then in our example, we have 5 units. So our fixed cost is still the same, 40,000, but will spread over the number of units. So it's 40,000 divided by 5 units equals 8,000. So if we have 10 units, then the fixed cost will spread over to 10. So 40 divided 10 equals 4K. And so if we produce 15 units, then 40,000 divided 15 equals 2.6. Okay, so as you can see, the fixed cost, if calculated per unit, changes, and that's the fixed cost. Now, for variable cost. So variable costs are expenses that vary in proportion to the volume of goods or services that a business produces. So in the other words, there are costs that vary depending on the volume of activity, and the cost increases as the volume activities increases. So, and it decreases as the volume of activity decreases. So the most common variable costs are direct materials, direct labor, transaction fees, commissions, and utility costs. So again, same product for fresh milk, and the sample variable cost are packaging, material, and human labor. Let's say the total variable cost is 50. So for 5 units, 5 units, 50 times 5 equals 250. And let's plot it again in the graph. So for 10 units, 50 times 10 equals 500 variable cost. So it goes up. So for 15 units, 50 times 15 equals 750. So for our total cost in variable is going to change. Unlike the total fixed cost where it stays the same with respect to the total cost and the cost driver activity. So now for per unit, for the variable cost per unit. So the variable cost per unit is the amount of labor, materials, and other resources required to produce your product. Still, it requires for the company to have a variable cost of 50 pesos to create one fresh milk. So the first unit is 50 pesos. Then if it is 5 units, then the price per unit is still 50 pesos. And it's 10 units, the price unit is still 50 pesos each. So for 15 units, still 50 pesos each. So I'm not saying that the 15 units are only 15 pesos. What I'm saying is that the amount per unit, since we're calculating the variable cost per unit, is still 50 pesos each. And as you can see, the variable cost per unit remains constant. So to summarize, we started with fixed cost first, and then fixed costs in total are going to stay the same regardless the cost driver activity, but the per unit is going to change. For the variable cost, the total is actually going to change if the cost driver activity change, and the per unit stays the same. So just a quick note on a relevant range. A relevant range refers to a normal range of volume or normal amount of activity in which the total amount of company fixed costs will not change as the volume or amount of activity changes. So let's say that each fresh milk is 50 pesos, so we are purchasing it from the supplier. Again, we sell between 20 to 80,000, and our variable cost of fresh milk from our supplier is 50 pesos. So it is the same if it's within the relevant range. But if we were to sell less than 20,000, which is outside the relevant range, we probably not receive a bulk discount from our supplier. So that would probably lead to a higher variable cost per fresh milk. Then we would have a raise of prices. So instead of 50 variable cost, you'll get your variable cost for 60 or more. So outside of the relevant range, the variable cost per unit changes. On the other hand, if we sold more than 80,000, so it exceeds our relevant range, but it's outside the relevant range, we'd probably get discounts, and let's say it will bring our variable cost down to 10 pesos. So instead of having a variable cost of 50 each, so you can get it for 40 each. So you would get the bulk discount, and variable per unit would change once again. So it's good to know this concept because when we actually look at cost functions to project cost, these cost functions will be created using a certain relevant range, and we won't be able to project cost outside of the relevant range because we'll have only created this cost function using the data within the relevant range, and that's the fixed and variable cost. Now let's learn about mixed cost. So mixed costs are a combination of your fixed and variable cost, meaning that it has a component that increases or decreases with the level of activity. It also has component that stays as is no matter what the level of activity is. So accountants look at your factory overhead account to find your mixed costs. And factory overhead contains all your manufacturing costs except the direct materials and direct labor. Some mixed manufacturing costs originate from your leased factory equipment and machinery, and a mixed cost contains a fixed base rate and variable rate that fluctuates with use. So for example, the fixed portion of your equipment lease is a flat 2,000 charge to produce from 0 to 10,000 units. So within that production, you will lease your equipment for 2,000 only. So even if you only produce 5 or 0 or 10 or 15, still you have a fixed rate of 2,000. Okay, but if there's a condition that you will be charged for 1 peso each unit over the 10,000 production, so if you produce 11,000 or you 10,001 products or units, then there's a 1 peso charge for each. Then that's your variable cost. So another example of fixed cost is cell phone plan. So this smart plan, iPhone 11 Pro, is 3,099 per month. And the 3,099 per plan there includes with 15 gig of data, only calls and text to network. So that's your fixed cost. So even if you don't consume the 15 gig of data, you don't consume at all. You only consume one or not at all. It doesn't matter because you will still pay the flat rate of 3,090. And while when the data exceeds, well, if there's a condition that if the data exceed 15 gig, there'll be charged for 5 pesos per 15 minutes. So that's your variable cost. Or when you call other network, that charge, for instance, is 6.50 per minute. So it means that the more you exceed your limits, the higher your bill is, or the higher your bill is going to be, and that is your variable cost. So there is a lot of different costs and mixed costs, and you can look at your various departments. For example, the quality control department. That department has a lot of costs in it, so some of which are variable and some of which are mixed. So most of the departments are mixed costs, and what we have to do is we have to separate mixed costs into variable components and into fixed components, and that's on the next slides and how to do that. So it might be difficult for managers to be able to plan, control, or make a decision when the set of cost information has mixed costs. Therefore, it will be helpful in managerial decision making to be able to see both the variable cost and the fixed cost component in a set of observation. So therefore, there are three methods to be employed in separating mixed costs: the high-low method, the least squares regression method, the scatter diagram. So first is the high-low method. High-low method is a mathematical method that cost accountant uses to separate fixed and variable costs from mixed costs. So we use the high-low method when the cost cannot clearly separate due to its nature. It will give us the estimation of fixed cost and variable cost. So the results may be changed when the total unit and cost of both point change. So now let's try. So let's try this problem and apply the high-low method. So the given is the Dayan company builds tabletop replicas of some of the most famous tourist attractions. So the company is highly automated, where maintenance costs show us a significant expense. So the owner decided to use machine hours as a basis for predicting maintenance costs and has gathered the following data for the following 8-month operation. Here's the step on how to do the high-low method. So first is determine the highest and lowest activity and the cost associated thereinto. So in our illustration, the highest is 9,000 machine hours and the lowest activity is 3,000. So remember, both include fixed costs and that we do not know how much yet. So second is that obtain the variable cost per unit by dividing the change in cost over the change in activity. So then that's variable cost per unit equals cost highest activity, which is the 24,800, minus cost at the lowest activity, which is the 9,800, divide highest activity, which is the 9,000 machine hours, minus the lowest activity, which is the 6,000 machine hours. So your variable cost per unit is 2.5 per machine hours. Next, you obtain the total fixed cost by removing the variable cost component in the total cost. So either you use your highest or lower activity, whichever you prefer, the result is still the same. So let's try the highest. Total cost, that 24,800 minus the one you calculate the variable cost component by multiplying the activity, which is 9,000, by the variable cost per unit, which is 2.5, and then we get the 2,300. And that's your fixed cost. So if we try the lowest activity, which is 9,800 minus 7,500, that's still has the same result, which is 2,300. So you know already how much is your fixed and variable costs. So in high-low method, it will not just teach you how to get the variable or fixed cost component, it will also help the manager to know how to estimate overhead so you were able to plan for it. So example, how much is the total cost maintenance cost at 8,200 machine hours. So we just use the formula since we already have the fixed cost of 2,300, then variables per unit multiplied to 8,200 plus the fixed cost of 2,300. So the estimated maintenance cost of 8,200 machine hours is 22,800. So how we'll be applying this high-low method in a managerial decision perspective is that the manager wants to determine what's really happening with our maintenance costs, right? So this is how we see the 8-month observation. So high-low method will not just teach you how to get the variable or fixed cost component. From a managerial perspective, you'll also determine the estimation so you can able to plan for it. So advantages of high-low method. It's easy calculation. So the separation between variable and fixed costs will not require any complex data or calculation. So we only need the total production and total mixed costs. And also accuracy. The high-low method can provide accuracy if the activity and costs are perfectly linear. Disadvantage of high-low method is it only works in a linear relationship. So this method only works if the activity and total costs have a linear program relationship. And in the real situation, it is hard to find a perfect linear relationship between activity and mixed costs. Then only take into account the highest and lowest. So the high-low method only takes into account the highest and lowest figure and ignore the whole year data. So the variable and fixed costs may not fit together when we apply to the rest of the year. So primary if the activity and cost is not entirely linear. So we're not able to see it. Then ignore inflation. Inflation is wholly ignored in the high-low method. So the variable and fixed costs will not will not be the same if we consider inflation. So we need to adjust it to our calculation and otherwise the figure will not represent the whole story. So oversimplification. This method is oversimplified cost behavior. So the relation between the production unit and cost is more complicated in real life. Then ignore step cost. Some fixed costs will not fix forever and it stays the same for within a product range. So if the activity increases more than the scale, the cost will increase too. So these are the pros and cons of high-low method. Now let's proceed to least squares regression method. Regression analysis, are also called least squares method, is a statistical technique that may be used to estimate a linear total cost function for a mixed cost based on past cost data. So the function can then be used to forecast costs at different activity levels and as part of the budgeting process or to support decision-making processes. So this is the most accurate method in segregating total costs into fixed costs. So like the other methods of cost segregation, the least squares methods also follows the same cost functions. It's x is the total cost, cost, a y-intercept, and b slope. So looking into differential calculus, we get the following normal equations. B is equals n times summation of x, xy minus summation of x multiplied to summation of y over n times summation of x squared minus summation of x. So using the normal equations and the process of elimination, we can derive a formula for this. How it works, let's use the same problem earlier. So here's the process. First, prepare our table calculating x, or the activity, y the cost, and xy the activity multiplied total cost, and x squared the activity multiplied itself, and get the total. So step 2, substitute the computed amounts in the following equation to get variable cost per unit. Then let's substitute. With that equals to 2.15. Then step 3, substitute B to any equation to get a fixed cost. So here's the formula in computing for the fixed cost. The fixed cost is A is equal to summation of y minus b, which we have just computed, times summation of x over n. Again, we get the figures from the table. So we have 2,315.63. So our fixed cost is 2,315.63. Since we already have the fixed cost, we can now try to project a manufacturing cost. So advantages and disadvantages. The least squares method had some advantages and disadvantages as well that make it more desirable in certain situations. The cons are simplicity. The method is easy to understand and perform. It's applicable in almost any situation. Honestly, it's hard to think of a case where the least squares method will be inapplicable. Then the technique has a strong underlying theoretical foundation in statistics. And the cons. As we already noted, the method is susceptible to outliers since the distance between data points and the cost functions are squared. So also, it has an inherent assumption that the two analyzed variables have at least some kind of correlation. And the least squares method might yield unreliable results when the data is not normal distributed. However, this can be mitigated by including more data points in your sample. So now the scatter graph method. So scatter graph method is a visual technique used in accounting for separating the fixed and variable elements of a semi-variable expense, also called as mixed cost. It is in order to estimate and budget for future costs. So it uses a graphical solution in separating mixed costs. It is used to determine a relationship between the two variables x and y. The x variable is the independent variable and the y variable is the dependent one. So let's apply scatter diagram in the same problem. And here is their procedure, and let's apply it together with our example. So this ABC company has a problem regarding factory overhead because maybe the cost for it is a mixed cost. So here's the data, the production level in units and the amount in in dollars. So we're going to use graphical method to analyze the relationship between the production level and the amount in dollars. Step 1, let's draw a scatter graph. So plot the data on a scatter graph, plot activity level, that is number of units, labor hours, or etc., and along the x-axis and the total mixed cost along the y-axis. Now let's plot this into a Cartesian coordinate plane. And we are going to use the first quadrant only because all of the figures are positive. And as you can see in the given, the production level is 1,520 in the first month, and the amount in factory overhead is 36,375. And the second month, it's 1,250 units, and the amount in factory overhead is 38,000. Month 3, 1,750 and 41,750. Month 4, 1,600 units and 42,360. Month 5, 2,350 units and 55,080 factory overhead. And month 6 to 1 and 48,117, 3,000 units and 59,000 factory overhead. Lastly, month 8, 2,750 units and 56,800 factory overhead. So step 2, draw a regression line. Draw a regression line over the scatter graph by visual inspection and try to minimize the total vertical distance between the line and all the points. So extend the line towards the y-axis and find the total fixed cost. So step 3 is finding the total fixed cost. So finding the total fixed cost is given by the y-intercept of the line. So the y-intercept is a point at which the line cuts the y-axis. So our line here intercepts around 18,000. So that means that x is 0, the y-intercept is 18,000. It is not really precise as the other two methods, but it will give us an idea how the relationship between the two variables are working. So step 4, find variable cost per unit. So variable cost per unit is equal to the slope of the line. Take 2 points, x1 and y1 and x2, y2 on the line and calculate variable costs using the following formula. So if you divide that, you will get $14.286. So the main point is to plot the numbers in the Cartesian plane. So one of the main points in the discussion of CVP analysis is the determination of the entity break-even point. So the break-even point is a point wherein the entity does not enjoy a profit but do not incur a loss, which is when the total contribution margin equals total fixed cost. So this is a determinant on how much sales or how much units to be sold to be able to at least cover all operational costs. So we have some assumptions in CVP analysis. Number one, costs are classified as variable or fixed. Two, variable costs change at a linear rate. And as you all know, that the total variable cost is based on the number of units that you have produced and sold, right? So variable cost in CVP analysis is really assumed that it's changing at a linear rate. And the higher the production, the higher the production cost incurred by the company. So number three, fixed costs remain unchanged within the relevant range. We know that relevant range is because we've discussed it earlier. So selling prices do not change as sales volume changes. So then inventory levels remain constant and it's not focused too much in CVP analysis. And lastly, volume is the greatest factor affecting cost. So let's discuss what contribution margin is. So as we all know that the income statement is sales minus cost of goods sold equals gross profit minus operating expenses, and that is the net income. However, in creating contribution margin, the income statement, we do it like this. So remember, the cost of goods sold has variable of goods sold and a fixed of goods sold. It also have a variable operating expenses and fixed operating expenses. So what happened in contribution margin income statements? So margin income statement is sales and deduct all variable costs and the difference is a contribution margin. Then deduct all fixed costs to get net income. So this equation is a contribution margin income statement, and coming from this formula, we can now compute your contribution margin approach in getting the break-even point. So for the first formula, break-even point in units equals fixed cost over contribution margin per unit, or the break-even point in sales equals fixed cost over contribution margin per ratio. So for example, Mary, the furniture owner, wants to seek a new type of table. Let's say the cost of it costs 90,000 retail space to sell the product, and that's the total fixed cost. And each table costs $160 in material and labor. So the selling price is 250 pesos. So let's answer these questions. How much is the contribution margin per unit and contribution margin per ratio? And I mean contribution margin ratio. And how many units should the entity sell every month to break even? And how much sales should the entity achieve every month to break even? And compute break-even point through an equation approach. Now let's answer the first question. How much is the CM per unit and the CMR? So here's our equations. Selling price per unit minus variable cost per unit equals contribution margin per unit. So you divide that contribution margin per unit to the selling price per unit. Then we get the contribution margin ratio. So selling price per unit, which is 250 minus variable cost per unit, which is 160. So 250 minus 160 equals 90. Contribution margin per unit. So then contribution margin per unit, which we got from above equation, which is 90 divided to selling price per unit, that equals to contribution margin ratio of 36%. So how many units should then, the next question, how many units should the entity sell every month to break even? So in here is our formula. Break-even point equals fixed cost over contribution margin per unit. So our fixed cost is 90,000, contribution margin is 90, so that is 1,000 table to break even. So the company should sell 1,000 tables per month to break even. So no loss and no profit. Number three, how much sales should the entity achieve every month to break even? So here's our formula. Break even point in sales equals fixed cost over contribution margin per ratio. So that would be 250,000. Or the other way, the break-even point per units multiplied to selling price per unit. So that's this 250,000. Compute the break-even point using the equation approach, which is the net income equals sales minus variable cost minus fixed cost. So net income is equals 0 because as we say at break-even point, your net income is 0. So sales is 250, variable cost 90, and we get 1K units. So graphing CVP relationship. So CVP relationship can also be expressed in the form of a graph called CVP graph. So the graph shows the relationship between total revenue and total cost. So the area between the two lines below the break-even point represents losses, and the area above the break-even point shows the volume of total profit. So this graph can be used to identify profit at different output levels. So always remember that your x-axis represents the number of units sold and y-axis is the sales or total cost. So the total revenue starts with 0, and while your sales increases, the line increases at a linear rate. However, the total cost line did not start with 0 because we have the concept of fixed cost. In the concept of fixed cost, in every level of production you produce or not, you will incur fixed cost. So in graphing CVP relationship, the point where they meet is the break-even point area, and below the break-even point is the loss area, and above is the profit area. So next is the CVP analysis with a target net income. What should we do if we have a target net income? So from this formula, just add target net income. So let's try the same problem earlier, but we will add a desired net income of 270,000. So first question, how many units should the entity sell every month to achieve the target net income? So fixed cost plus desired income equals contribution margin to achieve over contribution margin equals target sales in units. So fixed cost 90, desired net income 270. So 90,000 plus 370,000 equals 360,000. Divide contribution margin, which is 90. So the target sales in units is 4,000. So for the target sales, fixed cost, which is 90 plus desired net income before tax is 270, should we say 360. We divide that with the contribution margin in ratio, which is 36%. So the target sales is 1 million. So margin of safety. So in accounting, margin of safety is the extent by which actual or projected sales exceed the break-even sales. So margin of safety ratio equals to the difference between budgeted sales and break-even sales divided by budget sales. So the margin of safety is the measure of business risk, and it represents the percentage by which a company's sales can drop before it starts incurring losses. So higher the margin of safety, the more the company can withstand fluctuation in sales. So a drop in sales greater than margin of safety will cause net loss for the period. And there are different ways in which margin of safety can be expressed. It is in units of goods sold, in dollars of sales, or as a ratio. So here are the formulas of margin of safety in units. So margin of safety in units equals budgeted units minus break-even units, where break-even units of sales equals. So then the margin of safety in dollars can be calculated by multiplying the margin of safety in units with the price per unit. So margin of safety in dollars equals margin of safety in units multiplied to price per units. Alternatively, it can also be calculated as a difference between total budgeted sales and break-even sales in dollars. So break-even point in dollars equals fixed cost divided by contribution margin ratio. So while the margin of safety ratio allows comparison between the different companies, it can be calculated by dividing the margin of safety in units or dollars by total sales in units and dollars respectively. So margin of safety ratio in units over sales in units. So margin of safety in dollars over sales in dollars. So that's margin um, of safety ratio. So lastly, how can we get the break-even point if your company has two or more product lines? Now, let's learn about sales mix and the weighted average contribution margin. So sales mix is a proportion in which two or more products are sold. So for the calculation of the break-even point for sales mix, the following assumptions are made in addition to those already made for CVP analysis. So first is that the proportion of the sales mix must be predetermined. Second, the sales mix must not change within the relevant time period. So the calculation method for the break-even point of sales mix is based on the contribution approach method. Since we have multiple products in sales mix, therefore, it is most likely that we will be dealing with products with different contribution margin per unit and contribution margin ratios. And this problem is overcome by calculating weighted average contribution margin per unit and contribution margin ratio. So these are the used to calculate the break-even point for the sales mix. So let's try. So we have the selling price per unit, variable cost per unit, the sales mix percentage, and the total fixed cost. So step one, you calculate the contribution margin per unit for each product. Remember, contribution margin formula is sales minus variable cost equals contribution margin, right? So let's get the contribution margin for the three products. Product A, sales is 15, B 21, product C sales is 36, and the product A variable cost is 9, B is 14, and C is 19. So contribution margin are product A 15 minus 9 equals 6, B is 21 minus 14 equals 7, and C 36 minus 19 equals 17. So let's add it in the table. So let's add it in the table so we can remember it later. Step 2, calculate the weighted average contribution margin per unit for the sales mix using this formula. So product A, contribution margin per unit is 6 multiplied to product A sales mix percentage, which is 20%, plus product B, contribution margin per unit, which is 7 times the sales mix, which is 20%, and product C, which is 17 contribution margin per unit, and multiply to its sales mix, which is 60%. So that equals to weighted average unit contribution margin per unit is $12.80. Step 3, calculate total units of sales mix required to break even using the formula. So break even point in units of sales mix equals total fixed cost divide weighted average contribution margin per unit. So total fixed cost is 40,000 and weighted average contribution margin per unit is 12.80, which we calculated earlier, and 40,000. So 40,000 divided 12. 8.80 equals 3,125 break-even point in units of sales mix. So next is step 4. After that, you calculate number units of product A, B, and C at break-even points. So sales mix ratio multiplied to total break-even units. So that equals to product units at break-even point. So for A, its sales mix ratio is 20%, B 20%, C 60%, and multiplied to break-even units, which is 3,125. So A is, so they have the same 3,125. So A is 625, B is total is 625, and C is equals to 60%. C is 60% of 3,125 is 1,875 product units at break-even point. So lastly, step 5, calculate break-even point in dollars as follows. So product units at break-even point multiplied to price per unit equals to product sales in dollars. Then you sum the three product lines. That's the break-even point in dollars. So product units at break-even point, product A 625, B 625, C 1875, and you multiply to price per unit, which is the product A. Price is $15, product B price is 21, and C is 36. So this is the product sales in dollars, and add these three, the 9,375 plus 13,125 plus 67,500, and your break-even point in dollars is 90,000. So that's how we calculate break-even point in sales mix, and weighted average contribution margin. So thank you guys, that's all for me, and I'll give you to the next presenter, Eileen Adlaon, who will discuss variable and absorption costing.